Welcome to the MarketBeat Podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. So, the S&P 500 is down 6% year to date. Now, that is not bear market territory, but it kind of feels like it, doesn't it? So, at the very least, we know it's been unusually volatile this year, making it difficult to trade in the market's direction for any sustained time frame. So, how should you handle a bear market? As you'll hear in today's episode, Wall Street prefers you simply buy and hold, but as our guest points out, who benefits from that? You or Wall Street? Well, we all know the phrase about casinos, right? The house always wins. So you can apply that same logic to the question of who benefits from buy and hold. Back when I learned to trade, I was taught a system that emphasized getting into cash in a bear market. And while that may have made sense a few decades ago, you have other ways today to handle a downturn, like inverse ETFs, which can help you book profits in a bear market, or be used as a hedge against another investment that you may hold. Whatever you do, sitting through a bear market, just being hopeful that things will change is not the ideal strategy. Instead, today's guest offers some ideas on how to be more proactive and gives us a forecast for where the market may be in a dozen years. True story. Now, in my view, and from what I've seen with my clients, more people are terrified during bull markets rather than being complacent about maintaining portfolio gains. But really, neither approach is correct. And that's where our guest, Jon Wolfenbarger, gives us a dose of reality as well as some optimism about how to handle the coming downturns. And he has some very specific ways to gauge market strength and weakness and to help you identify when a bear market begins and ends. So you don't want to miss this. Here's my interview with Jon Wolfenbarger of Bull and Bear Profits. So, Jon, I know you look at a lot of stocks and also evaluate the market conditions, the economic conditions behind what's driving market direction. And one of the things that you and I want to talk about today is how to profit and outperform the market during both bull and bear cycles. So tell us a little bit about what the listeners need to know to do that, because that sounds pretty compelling.
Great. Thank you, Kate. And it's an honor to be here. Yes, my business is focused on helping individual investors profit and beat the market in both bull and bear markets. I look at 4 key sets of objective indicators to do this. I look at valuation metrics to estimate long-term returns. I look at leading economic indicators to determine where we are in the boom and bust business cycle. I look at sentiment indicators, which are leading indicators for changes in bull and bear market trends. And lastly, I look at technical trend indicators to determine kind of exactly where we are right now in a bull and bear market. So there are 3 basic ways to profit in investing and beat the market. The first way is the way that most people do, which is the most traditional way. It's also the hardest way to do it. And that is to pick individual stocks and ETFs with strong fundamental and technical characteristics that outperform. That's what I did in my career for over 22 years at Allianz Global Investors. That's what I do now in my website as well. I look for individual stocks and ETFs with strong fundamentals and technicals that can outperform. And that works great. It's difficult to do, but it works great, particularly in bull markets. In a bear market, it's much harder to find particularly stocks that will go up and that profit. At the bottom of the bear market in 2008, only about 3% of stocks were trading above their 200-day moving averages. So 97% of stocks were in downtrends. So in a bear market, it's really hard to profit that way. If you can identify a bull market and you can identify a bear market, then it becomes much easier. In a bull market, once you have identified that, it's easy to match the market, of course, by buying an ETF such as the SPY, matching the S&P 500. It's very easy to also beat the market substantially simply by buying levered long ETFs. So there are ETFs that go up double, some even go up triple the amount that the market goes up. So if the S&P 500 is going up 10%, usually in a bull market, stocks will go up at least 10% a year. If the S&P 500 is going up 10%, you can buy a levered long ETF that goes up 20%. That one, the ticker is SSO. It's an ultra S&P 500. There's one that goes up double what the NASDAQ 100 does. The ticker is QLD. There's levered long ETFs for really all major asset classes, US stocks, international stocks, and others. So that's in a bull market. In a bear market, and bull markets are really easy. If all we had were bull markets, life would be wonderful and investing would be great.
Everybody's a genius.
Exactly. We could talk about what's going to go up the most. That's much more fun. Mm-hmm. But in a bear market, and they're rare, they don't happen often, but when they do happen, they can be really brutal. And as you know, we had a couple of really brutal ones in the early 2000s and then 2008, 2009. And in that case, there are some stocks, that you can find that, again, maybe 2 or 3% at the bottom of a bear market that are still going up. Those are hard to find. The easier way is to look for ETFs that are going up, defensive type ETFs. In 2008, 2009, for example, the long government treasury bonds went up about 25%. So the standard thing in a bear market is to switch out of, generally out of cash and into bonds, government bonds. So that usually works in a bear market. It did not work in the 1970s bear markets, where we had very high inflation, and we're having high inflation now. So as you know, bonds have been tough now.
Yeah, John, I was going to ask you, hasn't it been the case like in 2021 where there was some correlation between the equity and bond markets in certain periods of time recently? I think we've seen that a few times lately.
Yes. I think they're moving in some ways because we're in such an unusual period. It's really the first time in most investors' lifetimes where we've had high inflation. Inflation's running 7% now. That's really accelerated in recent months.
It is.
And it is like the 1970s. In the 1970s, were a terrible time for stocks and bonds. Traditional financial assets were terrible, but it was great for commodities. And that's what we've seen since the March, 2020 low. We've seen a massive outperformance of commodities and significant underperformance of bonds. So bonds have really taken a hit with the high inflation. Stocks, have done very well since obviously the March 2020 lows. We had, 40% increase in the money supply, which has fueled this inflation we're seeing now, but it also fueled this big bull market in stocks. So I think that's why we're seeing a divergence lately between stocks and bonds. But, stocks have weakened, quite a bit the last couple of months, which we could talk about. But generally, I wouldn't say we're officially in a bear market now, although most, in terms of US stocks, but most international stocks are in bear markets. Most, again, stocks and bonds of virtually all flavors are outside the US, and bonds in the US are in bear market. But the S&P 500, still, I wouldn't say technically in a bear market. But once we are officially in a bear market, and I can talk about what I look for to determine whether you're in a bull or bear market, you can simply buy inverse ETFs. So these ETFs did not exist, in the early 2000s bear market, but they did exist in 2008, 2009. So these are ETFs that go up by the amount that stocks go down. So there's an inverse S&P 500 ETF, the ticker is SH. There's one for the NASDAQ 100, the ticker is PSQ. And there's also levered inverse ETFs. There's a S&P 500 one, the ticker is SDS. So in 2008, 2009, the S&P fell about 60%, but the SH, the inverse, rose about, I think it was about 90%. And the double inverse S&P 500 SDS rose about 180%. So you could have made enormous profits during that bear market. So if you can make profits, great profits in a bull market and in a bear market, then you compound your returns significantly and earn much more wealth than a traditional buy and hold investor will.
So John, let me ask you this, because I do use some of these in some of my portfolios. It's been tricky lately, just with some of the market volatility, right? It's like the market seems to change direction. And then I think I had the SH, and then just when I sold it, the market started going up again. And I realized that these are not buy and hold vehicles. I totally understand that. But is it the case that investors really need to become traders, in effect, or not? Is there a different way to be handling these?
Right. Well, the inverse ETFs are designed for daily performance. If the S&P goes down 1% during the day, the inverse should go up 1%. The double inverse should go up 2%. So they are designed that way. But if you actually look over time, years at a time, these, particularly the inverse ETFs for the large indices, such as the S&P 500 or the NASDAQ 100, those actually track the performance as pretty close to how you would hope them to track over years at a time. So it's somewhat of a myth that you can't invest in them for months at a time, or, the odds are we're not going to be in a bull market for, 5 years, probably, hopefully. You could have made a lot of money over 6 months, 12 months, 18 months in these funds. But yes, they, as with anything, the market has its ups and downs. It doesn't move in a straight line, either down or up. So, we've had a big rally in stocks the last couple of weeks. And so the inverse ETFs naturally sold off, as you would expect them to. So in a bear market, I can tell you, kind of what I look for to identify a bear market. And then there are ways to trade within a bear market, if you're interested.
Yeah, let's talk about that.
Generally, I look at a lot of indicators to determine the trend of the overall market. Advanced decline lines, new highs and new lows, things like that. That gives me a broad picture. But for any given asset, if you just look at just a chart of let's say the S&P 500, just a chart of it. And I looked at this in the early 2000s, in 2008, 2009. Generally 4 criteria define a bear market, I think. Okay, basically, they're very simple. So if you have a price chart of the S&P 500, and they use moving averages, I use a 20-day moving average for kind of short term, a 60-day I use for longer term or medium term, and a 250-day I use for longer term. A lot of people use the 200. It's very similar, but it gives you a little bit fewer head fakes. But generally, what you see when a bear market starts is the price of the S&P 500 will fall below its 250-day moving average, its long-term moving average. And then next, the 20-day will fall below it. And then lastly, the 60-day will fall below it. It's the more lagging indicator. So when you have the price, the 20-day, and the 60-day all falling below the 250-day, that's usually about when the 250-day moving average starts to slope downward. And so when you have all of that, you have kind of confirmation of a downtrend, a significant downtrend. You haven't just dropped below the 250-day for a day or a week. It's a more persistent trend. And generally, when all of those things are in downtrends, the 60 days below the 250-day and the 250-day is sloping downward, you can call that officially a bear market. And I looked at this in the last 2 bear markets. If you bought the inverse ETFs then, and you held on to them the entire bear market until all those conditions reversed, the price rose above the 250-day, the 20-day rose above, the 60-day rose above, and the 250-day slope turned positive. So you had a reverse of those indicators. If you had held those inverse ETFs or shorted the S&P 500 essentially during that time, you would have made about a 30% profit.
You just gave us a formula right there. Listeners, that was the formula he just gave you. And I'm looking on a chart here. I've got some different moving averages. I do have the 200, I have the 50, I have the 5, I have the 21. So I think you get some similar indicators. I'm not going in and changing them right now, but I see your point about that. I mean, just kind of using some of these as proxies. Yeah.
Right. And just a couple little points about that. So first of all, if you had just done that in those last 2 bear markets, you would have made roughly 30% profit instead of losing 30%. So if you had started with $100, you would have 130 instead of 70. And so that's, I think, an 85%, higher wealth essentially at the end of the day. So it has a huge impact on your wealth and your compounding of returns over time. So even just making that 30% profit instead of losing 30%. And one thing about these indicators, you can start to, for example, in March 2020, we had that very short crash, right, where the S&P fell, 30, 35% or so. It was very short. These indicators, it happened so quickly that they didn't really kick in, essentially, until the crash was over, more or less. And so the bad thing is you wouldn't have really profited from that crash. But the good thing is you wouldn't have gotten in, the crash was so short-lived and it was over so quickly, you wouldn't have gotten whipsawed so much by the crash. So these indicators work well for kind of a longer grinding bear market like we had in the early 2000s and in 2008, 2000, rather than a crash, which in a crash, if it's, if the market's going to crash and then bounce right back, maybe it's not worth messing with too much.
Right. And what's so interesting about that is to look at what your indicators are doing. Don't go by opinion. I mean, March 2020, everybody was understandably very freaked out.
Exactly.
Nobody knew what was going to happen. It seemed quite reasonable to think that the damage to the market may have been far more widespread than it ended up being. But again, I think kind of looking at what the charts are actually telling you, rather than relying on the news, relying on your own fear, your own opinions, I mean, that can really help you get through one of those time frames, can it?
Absolutely. No, it's such a fantastic lesson. And you said it exactly right. We had an inverted yield curve or flat yield curve, but somewhat inverted in 2019. And every time, as you know, since 1970 or so, every time we've had an inverted yield curve, you have a recession, could have been, potentially bear market. So even before COVID, we had an inverted yield curve, which was suggesting we were going to have a recession in 2020 with a likely big bear market. And then COVID came on top, global depression, essentially. I mean, it's the worst news, some of the worst news we've seen in our lifetime. And if you just thought about that logically, like an economist or what have you, you would have missed this entire rally. So that's why you have to, the number one most important thing is to focus on the charts and the technicals and investor sentiment.
Right. Great advice right there. As a trader or investor, you need timely information to help you make better decisions. And analyst upgrades and downgrades can give you the outlook for the stocks you're watching, coming from the big institutions who are behind 75 to 80% of market movements. For absolutely no cost, MarketBeat will send analyst recommendations right to your inbox daily. You will get a concise summary of analyst upgrades, downgrades, and new coverage, along with relevant news and information for the stocks on your watch list, real-time portfolio monitoring tools, a rundown of the top headlines each day, market calendars, the MarketBeat mobile app, and other research tools. Don't miss out on this. Sign up right now. It's 100% free. You'll find this at marketbeat.com/ratings/newsletter. That's marketbeat.com/ratings/newsletter, and that link will be in the show notes. Okay, Jon, let's switch gears a little bit. And let's talk about some specific securities you're looking at right now and how and why investors should be looking at these at this time.
Sure, great. Thank you. So as you know, we've had a big commodities bull market, as I mentioned, since the March 2020 low. Commodities have been outperforming stocks. And commodities, and I can talk about this in a second, but stocks are the most expensive they've really ever been in history. And because of that, there's a valuation indicator, and based on the historical performance of that valuation indicator, it suggests that stocks will likely be at least 50% lower 12 years from now.
Wait, 12 years or 12 months?
In 12 years, based on this indicator, stocks will likely be at least 50% lower, assuming this indicator works as it has in the past. It's essentially the total stock market divided by GDP, which Warren Buffett says it's his favorite valuation indicator for stocks. And there's an economist, John Hussman, he's a fund manager and economist, who's done great work on this and determined that you can predict 90% accuracy the returns over the next 12 years for the S&P 500 based on this indicator. And again, based on that, stocks will likely be at least 50% lower 12 years from now, which is shocking. But a lot of people don't remember that, bear markets can last a long time. It took the S&P 500 25 years to recover to its 1929 highs. It took the NASDAQ 15 years to recover to its 2000 highs. It took the Japanese stock market is still about 30% lower than it was in 1989, so 32 years later. So stocks can stay down for a long time. Now, they don't stay down in a straight line. There are bull and bear market cycles along the way. But anyway, the point is, we know bonds offer very low returns right now. 2.5% interest rate on the 10-year Treasury is some of the lowest in history. And after inflation, it's a very negative real return. So bonds do not offer attractive long-term returns. Stock market overall does not offer attractive long-term returns. It looks like they'll be pretty negative for a while. But commodities are actually very cheap relative to their history, relative to GDP, relative to stocks. They look very cheap on an absolute basis. And they've been in a bull market the last couple of years. The Fed has increased the money supply by 40%. We have all this liquidity going around. And now we have, we've had these bottlenecks related to COVID. And now we have this Russia-Ukraine war. As you know, Russia is a large provider of commodities. So, the best stocks and ETFs right now that I've been recommending to our members are, stocks like Halliburton, a major oilfield services company, Triton International. It's the world's largest lessor of freight containers. They're benefiting from supply chain bottlenecks and container shortages. Devon Energy is an independent oil and gas company I recommended. It should have about 60% earnings growth this year and about a 6% dividend yield. So I think there's more room for commodities to go over the coming years. And so commodity stocks are interesting. There's commodity ETFs, like Invesco has a no K1 ETF called ticker PDBC. There's ProShares has a K1 free oil ETF, OILK. Fidelity has a ETF, Fidelity Stocks for Inflation, do well when inflation's high. So there's a lot of interesting, I think, commodity and inflation plays out there right now.
That's interesting because I know some investment philosophies or trading philosophies, perhaps more accurately, in the past used to suggest just go into cash during a downturn. I feel like we're kind of beyond that because nobody wants to sit in cash. Everybody wants to look for some opportunity, as you were saying, to maybe make a return, a 30% return, even while the market is going lower. So you've given us a couple great ideas there, some of these inverse ETFs, and then to also look at asset classes that may be performing better at any given time.
Right. And I do think the 70s are a very interesting time to look at. And I have an article on my website about it because most people, I was a kid in the 70s, that, most investors now don't remember very much about it. But the 73 to 75 bear market was the worst bear market since the Great Depression up to that time. The S&P fell about 45%. And during that time, again, stocks went down 45%, bonds did horribly because you had high inflation. But commodities, oil and commodities did extremely well during that time. So, that's a stagflationary period, which, particularly, God forbid, this, war gets any even worse or, exacerbates, then, we could be in for a major stagflationary period, in which case I think you can invest in, generally commodity stocks, commodity ETFs, gold, other commodity ETFs. And there are also, there may be some defensive stocks. Right now, there are some defensive stocks, which, I don't think are impacted by the economy much. There's some healthcare, managed care companies. There's one I like a lot called Molina Healthcare, ticker is MOH. They do managed care for Medicare and Medicaid, so very little exposure, to the economy, and they should grow earnings about 30% this year. So there are some defensive names out there, but yeah, I think the place to be, given what we see right now, it's in commodities. And then if we do, again, officially see all the signs of a bear market, then I think these inverse ETFs you can make a lot of money on.
Now, you mentioned looking 12 years ahead. And I'm still kind of back on that because it's kind of mind-blowing, really.
Yes.
But what I think you're telling us, but I just want to verify this with you, rather than saying, hey, I'm pretending I can see the future 12 years ahead, investors should just keep looking at the charts, looking at asset classes performing well. Is that correct? And kind of don't worry about 12 years from now?
Yeah, no sense worrying. My only reason to mention, again, there's about a 90% correlation with this metric. Again, it's essentially stock market cap to GDP. And I just wrote an article on my website. People can look at all the details. You can even look at dividend yields, historic lows, the Shiller PE. So, for example, the Shiller PE, which, is the price of the S&P 500 divided by the average earnings per share of the S&P 500. It was at these levels at the tech bubble peak in early 2000. And so that was kind of the most expensive the stock market ever was at the tech bubble peak, based on that measure. And 9 years later was the 2009 bottom, and stocks were down 55% 9 years later. So that's the kind of thing, it sounds shocking to say 12 years you're down 50%, but from 2000 to 2009, we were down 55%. Again, the Japanese stock market, a huge bubble in the 1980s. 20 years later, in 2009, they were down about 80%. So, these things can happen. Gold was down 70% from 1980 to 2000. So things can go down a lot and stay down. But yes, you're exactly right. I mean, it's important, I think, to know that. And the reason I mention it is for people who, they've been told by Wall Street essentially to buy and hold forever. And buy and hold for Wall Street, advisors is kind of easy money for Wall Street advisors. They don't have to really do anything. They just put the money there and then they collect steady fees. They don't have to tell people, oh, we might be going to a bear market. You should do that. It's kind of easy money. So I think for people who've been, it's been such an amazing bull market, the last, since 2009. I think I just want to kind of shake people out of their complacency and say, you need to be prepared to identify when a bear market starts and when it ends, because there will be, I think, cyclical bull and bear markets the next 12 years, just like there usually are, and learn how to profit from them. And the thing that most people think is, well, a bear market, 2008, it went down, but then it came back in a few years. If you just buy and hold, it always comes back. Stocks always come back for the long run. Again, I just said, it can go decades. And I don't know how, if you're 20 years old, maybe you can wait 25 years. I'm not 20 years old.
No,
so
right.
In 25 years, I need to make some money. So I think people just need to be reminded that stocks can go down a lot for a long period of time. And they need to be able to be more active and look at the charts and profit when you have a nice bear market, and also be able to profit when you have a nice bull market, and also be able to profit in a bear market.
Yeah, that reminds me of my background as being a financial advisor. And one of the concepts that would come up was the sequence of returns risk. And if you're withdrawing from equities when equities are trading low, then you lock in losses, you reduce your spending power over the coming decades. And I think what you're saying here, Jon, is that could be a very big risk, even if you are conscious of the sequence of returns and what your withdrawal schedule might be. You could still be seriously reducing your spending power in retirement, say, if there is a prolonged bear market, if you're not prepared to do a little more active trading.
Right, exactly. Another example I'll give you is after the Great Depression, Great Depression. So stocks, I think, the stock market fell about 90% in the early 30s. That was a low. You could have, if you made money in that bear market, that's great. And then you could have you could have played the subsequent bull markets that happened after that. But even, I think 1941 or so, stocks were still, I think, about 50% lower than they were in 1929. So they were, down 90%. They ended it down 50%, but you could have made a nice profit during that bull market after the initial big decline. So again, there are bull and bear market cycles, but it's just important, I think, to not get complacent. Right now, just assume that stocks always go up and they'll always be higher 5 years from now or 10 years from now. That just isn't the case historically, and it doesn't look like the case given the valuations of the stock market right now.
Hey, this is some great advice. You've not only told the listeners how to think about the different market cycles, but also given us some very specific examples of stocks and ETFs to be looking at now, and how to think about using these in the various up and down market cycles. So, Jon, I am looking at the time here. I know we got to wrap up. You mentioned your website and some of the articles there. How can the listeners find you?
Thank you very much, Kate. Thank you. Yeah, so my website is called bullandbearprofits.com. Everything is completely free on the website. You could just sign up there with your email, and you can access webinars, special reports. I write articles every week, all for free. Also, for a limited time, for the next 6 months or so, I'm providing 4 to 10 new stock and ETF recommendations every single month. So you give specific actionable recommendations. I provide exit prices, a target price, and a trailing stop price to automate the exits. So I provide really everything in the service right now for free. In about 6 months, I will start with a paid newsletter that will have, a lot of written content as well, in addition to the recommendations. But for now, you can check it out for free and see what I have to offer, and hopefully learn a lot about bull and bear market cycles and how to profit from them.
Yeah. Hey, this is great. And that's very generous of you. Really appreciate that. Thank you so much, Jon. Really enjoyed talking with you today, and hope to have you back on the show some other time.
Thank you very much, Kate. I really enjoyed it.
All right. That's a wrap on this week's episode. Thank you so much for listening. Don't forget to subscribe so you don't miss a single episode. You'll find the show on all your favorite podcast apps: Spotify, Stitcher, Google, Apple Podcasts, of course, anywhere else you get your podcasts. And you can always find us on MarketBeat.com. And please, if you're enjoying the timely market insights we're bringing you each week and finding them valuable, please give the show a 5-star rating on Apple Podcasts. That will help others find the show so we can bring these investing ideas to an even wider audience.